this is Ernie Burns with Burns Estate Planning and Wealth Advisors, and this is our next coffee chat. Joining me today is
Ashley Terrell, Financial Advisor for our West Palm office.
There we go. Okay, so we have 12 offices now in 3 different states, Louisiana, Alabama, and Florida, across Florida now with Ashley there. We're going to talk about a subject today that we have not talked about in some time because it concerns all of you. If you're looking at retirement or you're currently retired, you probably have had this product pitched to you or suggested to you, or you might even have this product right now. The thing about it is, this product is has a unique time period. In the last 30 plus years of business I've been doing this, we've never had this opportunity. What I'm talking about is a fixed indexed annuity. Now, we're going to explain very detailed, okay? We're not sitting in front of you, we're just on your screen. Very detailed, the benefits, the pluses and the negatives behind this right now for you, and you can determine if this is right for your portfolio or your financial professional can. If they've never suggested it, maybe call us. All right, so what has happened right now hasn't happened in over 30 years. And the reason I'm saying that is this: interest rates. Remember in the 80s, you guys had, or maybe your parents had, CD rates at 15%, but unfortunately you had a mortgage at 17%. You know, by 1991, those rates dropped to 3%, and for 30 years we've had between a 3 to 5% rate of return or rates out there for CDs, and also some loans if your credit was really good. Point of take, it was very low rates for 30 years. Most people haven't seen high mortgage rates their whole life. Some or half the people haven't. That being the case, what's happened in 22 is monumental. In 22, interest rates started rising. Now, here's why this is a big deal about annuities. 87.5% of fixed index annuity has to be government insured in the sense of 10 to 30 year government bonds. The insurance company has to have that portion of that return in government bonds, of those bonds invested through that insurance company. So therefore, that's why returns on insurance companies are not very large. I mean, 87.5% are in bonds. But in 22, when they started buying these bonds to protect the annuities that they were going to write that year, or those new contracts, those rates are more than doubled or tripled what they were previously. What that's done for us, Ashley, is given us the opportunity to offer clients rates that we've never seen before. 8, 9, 10, 12% cap rates. And I'm getting kind of detail and technicalities here on participation rates, 150, 200% returns in the last 2.5 years now. So my point by bringing this up, Ashley, is I think it's an important time to talk and let everybody know about this.
Let them be aware of the opportunity that we're presented with right now.
Yeah, and here's a now key thing too. It needs to be a client product, not an advisor or agent product. Okay, there's insurance agents out there, not very many, but there's a few out there not looking for your best interest, they're looking for their best interest, and that's how some annuities get bad names. We're talking about a fixed index annuity that is client favored, okay, and we're going to go through some of this now. We've been doing this for 30 years. We've done several $100 million in annuity products, as well as assets under management we do also, but this is a good time because some of you are hating the stock market right now. It's so volatile. You're retired or you're about to retire. You don't like this volatility. Or this annuity might be a good selection among your other investments, one of the buckets you use amongst your other buckets of investments that would fit in more conservatively. Because explain a little bit how annuity works.
So to build on what you were saying as far as the different products and making sure that it is suitable for the client, you want to make sure that your advisor is a fiduciary and that they can shop those different companies and they're not tied to just one insurance company.
Right.
So it's super important to make sure that you have the right advisor to accomplish that for you. But an annuity is a really good way to secure your assets and make sure that you have a certain bucket protected. With all of the volatility going on right now, people are concerned, they're worried, and they want to know that they have some of their assets in a safe place, and now is the best time to make sure that that allocation is where it should be.
And you're buying in, for example, one of the index allocation choices we have in one of our fixed index annuities is the S&P. Another one's the NASDAQ. Look at what you're buying in at also. You're buying in very low. So in 22, when this occurred, when the market went down 20+% that year, we were obviously doing some of these products because look at the opportunity we had. Those returns, I don't even want to tell them. The returns have been incredible the last 2 years for these clients. So double-digit returns. This gives you a great opportunity. So explain a little bit how a fixed index annuity works.
So you take your principal. You then get to select what the allocation inside of it is. You can do anything from the S&P 500 to the NASDAQ, even a fixed income portion if you'd like. So you're locked in every single year. Whatever it makes that year, you're locked in and you're not going to lose any principal from there. And it's a good way to protect what that annuity is doing and what it's making. Take advantage of the upside of the market that we're going to see sometime this year, as well as do it in a safe way. They also have a lot of bonus opportunities, which can make up for some of that market fluctuation that we've experienced so far this year. The S&P 500 is down 8% as of today for the year, and some of those bonuses, most of them are well above an 8% bonus. So that is a really good way to get back what you lost and then protect it for the future.
Now, also, I want to talk a little bit about that, is the returns. Yeah, you can make a good return, but some companies in the past, because those rates were locked in for 30 years, from 91 to 22, right before, well, 21, let's just say 21, and you were buying an annuity or invested in an annuity in that time period, the rates really didn't change very much. Or they bonused some of you that experienced annuity investors, they give you a nice little rate of return the first year and drop it the second year. With our products, they're not doing that because the bond rates they bought into those annuities that are protecting those annuities this year in 22, 23, 24, 25 now are so much higher, and they're carrying over year to year. And the reason I know this, I have one. And they're carrying over years, so the cap rates and participation rates are staying high. That's what they're saying, Ashley. This is just a great time to take advantage of that. Like I said, this is not for all your investments. This is for a portion of it, one of the buckets to benefit yourself in the future.
And one of the things that we've been seeing a lot of is those annuities that were written prior to 2020. Like Ernie mentioned, those rate caps were low. The participation rates were low. Today, they're so much better. So we're able to do a replacement, get a better product that's paying a higher rate, as well as take advantage of that bonus. So now is the perfect time to replace some of those older annuities that aren't giving a great of a return as we see today.
That's a great point. Prior to 21, if you have a fixed index annuity or a fixed annuity or a variable annuity, which we've never offered variables, that's a different subject. But if you have those products prior to 21 and prior, this would be a good time to sit down with us. Or we can Zoom you if you're in Connecticut, wherever you might be. We can Zoom you and we can do all this. Point of take is this would be a good time to get a second opinion and see if you could do it, if you could get a better option for you. And like she said earlier, if you still have a surrender charge involved, with the bonuses now in double-digit gains in the bonuses up front, it can make up some of those losses. Is it the right thing for you? I don't know. But this is a good option for you to look at and consider, because when interest rates come back down later this year and next year, as Chairman Powell starts lowering his interest rates, as he lowers them, these cap rates are going to lower for new products. So this is a great time to maybe look as an investment alternative that you don't have right now. So if this is of interest to you to look at, look us up on the web at burnsestatePlanning.com or burnsestateplanningwealthadvisors.com. Give us a call at 800-308-4416 or look us up on the web or call one of our 12 offices. You guys have a great day or great night whenever you might be looking at this, or even a great morning. But this is a great opportunity possibly for you. You guys take care.